Today's Cardinal lesson is going to talk about state income taxes, sales taxes, inheritance taxes, taxes on your Social Security at the state level. When we're going over this, typically we're talking about the federal income tax, which is the same for everybody all over the country, and it is the largest piece of the puzzle. So that's where most of our planning is. We haven't talked about the state taxes, and in my books that I published, it really doesn't go over state income taxes or state taxes in general, mainly because they're different in every state. This book would have been much thicker. And secondly, it's just hard to write about something that's different in 50 different places. So most of the articles that you read in the media are very good, and they're going to break it down by state, but the context of them is you choosing what state you're going to retire to. And the reality is most folks don't make that decision at all, or they don't make it based upon income taxes. Like I live in the Raleigh-Durham, Chapel Hill area, and we have tons of retirees coming in here, mainly because their adult children and their grandchildren live and work here, and they're from different places, and we've got great universities here and a whole diversity of retirement. People will choose our area because of that. Many folks continue to live where they're from. They like it there. So to get into like making decisions about where you're going to live in retirement based upon taxes and then state income taxes, I think is somewhat of a false presumption, because it's just a factor. Now, where we do get into this and have gotten into this is we do retirement planning and financial planning for retirees or getting ready to retire people all over the United States, in all 50 states and the District of Columbia. And when somebody hires us to do a financial plan for them, we're going to get in and look up all the state income taxes that they may face in retirement and even in death with their estate. So let's talk about this a little bit. So this differs in every state, and what we're talking about here are state income taxes is really the biggie. So like in North Carolina here, it's like 5.5%. That's just a simplified version of it. It doesn't have a lot of exemptions. And when you add that onto the federal tax, it's pretty significant. And when you're in Florida, there is no state income tax. So that's why you see a lot of retirees. That's one of the reasons in Florida is because they don't have to pay any state income taxes. And a lot of people will choose Florida, not only for the weather, but that's just a side benefit. And if you're one of these people that's fortunate enough to have two residences, they call them snowbirds down there in Florida, is that people who live part of the year there and part of the year wherever they're from, then you're going to have to pick a state, and then you're going to have to live there more than 6 months of the year, 6 months and a day, but you're able to have a little bit of decision over this. And we want to make people familiar with this a bit as a consideration, and we also want them to know that we're very familiar with it as financial planners. So like using Florida as an example, you have no state income tax there. And secondly, you don't have any estate or inheritance tax, and their property and sales taxes are just basically around average. So that is, if you're picking somewhere, that is desirable. You have a lot of people in Nevada or Las Vegas or somewhere in Nevada that are really California people, but they have their domicile in Nevada and they spend most of the year in Nevada, and then they visit California or they have a second residence, and you're talking about a difference of like 12% state income tax and no state income tax. So that's a big incentive to domicile in Nevada. So let's go through and talk about some of those taxes. Income taxes, and then you've got estate and inheritance taxes. And at the federal level, estate and inheritance taxes have very high thresholds so that most of the population of the country is going to pay no inheritance taxes. And so many states just dovetail in with the feds, even if they have an inheritance tax, they enjoy the same thresholds. But there are plenty of states that have like $1 million threshold where they're going to hit you with state inheritance taxes, like New York, Pennsylvania. There's a number of them that are going to still come back and get an estate. And when we're doing estate planning as part of retirement planning, we need to know this stuff and plan for it. Social Security taxes. So the feds are going to tax Social Security, but only based upon your other income. And we've done several lessons on that and continue to plan, and the federal tax is the most important part. Many states exclude Social Security or income taxes on your Social Security, period. Like North Carolina is one of those, is that even if you have to pay federal tax on your Social Security, you're not going to have to pay any state income tax on your Social Security. And then many states, the taxes are higher, or the thresholds are lower on the Social Security income tax. So it's all over the board. Then you got taxes on pension distributions, and I'll use my North Carolina example. They're going to tax your full pension. Okay, not your Social Security, but your pension if you're receiving that. A lot of folks don't have those anymore, but if you do, you're going to have a state income tax on that pension. Taxes on IRA distributions, again, so that's what people have in place of pensions. The federal government is going to tax distributions from your IRA as regular income, as ordinary income. Some states exclude that, some states have thresholds. And as an example, my state of North Carolina is going to tax those fully at that 5.5%. So when we're doing our planning and we're making decisions, we want to take all this into consideration as perhaps we're doing like Roth IRA conversions, where we're moving money from your traditional IRA to your Roth, or we're proposing that you do that, and we're staggering it over a few years. We need to take into account the state income taxes that you're going to pay on that transfer, as well as the federal income taxes. Sales tax and property tax, we don't get into too much planning on that, but it is a factor and it is a consideration. And many states that don't have an income tax, they're going to make up for that in their property taxes and their sales taxes as well to make their budget balance. So we've got some examples here, like Florida. We've already talked about that a little bit. We talked a little bit about North Carolina, that they exempt the Social Security income. California is going to taxes income from retirement accounts and pensions. So they're going to get your pension, they're going to get your retirement account or your IRA distributions, and they also have high property and sales taxes. So it's pretty much a high tax state, and they've got a high level of services there. But when we have many clients in California, we got to plan for this stuff, and we need to know that it's coming, if we suggest something or we put a budget over a number of years. So I'm Hans Scheil. I've written a few books on these subjects. You can learn about those at our website, cardinalguide.com. You can give us a call. I'm Hans Scheil, and I thank you for listening.